Tempus AI, the oncology data company operating the world's largest cancer clinical data library through genomic sequencing for oncologists and AI data licensing to AstraZeneca, GSK, and Merck.
FY 2025 revenue $1.27 billion, up 84%. Q1 2026, $348 million, up 36%, approaching its first profitable year as pharma data licensing accelerates.
Eric Lefkofsky founded Tempus in Chicago in 2015 after his wife was diagnosed with breast cancer, and he discovered oncologists were making treatment decisions without access to organized genomic data.
Tempus began partnering with cancer centers in 2018, building a longitudinal database linking tumor genomics to outcomes, a dataset no single hospital system could create alone.
Tempus went public on NASDAQ in June 2024, raising $410 million. AstraZeneca and GSK signed multi-year data deals, transforming data and applications into a high-margin revenue stream.
Diagnostics generates 75% of revenue through genomic sequencing tests ordered by oncologists, tumor profiling, RNA sequencing, and liquid biopsy across 300-plus cancer center partners.
Data and applications, 25% of revenue, licenses Tempus's data library to pharma for drug development and trial design. This segment grew 40% year-over-year in Q1 2026.
FY 2025 revenue $1.27 billion at 69% gross margin. GAAP operating losses narrowed from negative $458 million to negative $239 million.
Q1 2026 revenue $348 million, up 36%. Non-GAAP EPS negative 13 cents beat the negative 20-cent estimate.
Guardant Health competes in liquid biopsy, a narrower focus than Tempus's full genomic and clinical data platform. Foundation Medicine, now under Roche, was the original comprehensive genomic profiling competitor.
Veeva Systems dominates pharma data and CRM, a profitable, slower-growing comparison. Illumina supplies the sequencing instruments powering Tempus's diagnostics, making it both a vendor and an indirect competitor.
Tempus's moat is its data flywheel. Each patient's data improves the AI models, attracting more oncologist partners and generating more data. 11 years of oncology data cannot be quickly replicated.
Tempus partners with over 300 cancer centers, from Mayo Clinic and Northwestern Medicine to community oncology practices. The TEM platform matches patients to open clinical trials in real time.
A Merck collaboration adds to existing AstraZeneca and GSK deals, validating Tempus's data as indispensable to pharma R&D. FY 2026 revenue guided to $1.59 to $1.6 billion.
Eric Lefkofsky is co-founder and CEO, a serial entrepreneur who co-founded Groupon, Inner Workings, and Echo Global Logistics, taking all three public before building Tempus from a personal cancer experience.
Lefkofsky holds a BA and JD from the University of Michigan and is co-managing partner of Lightbank. He retains majority voting control of Tempus and remains deeply involved in clinical partnerships.
Tempus AI, the oncology data company, $1.27 billion in FY 2025 revenue, operating the world's largest cancer clinical data library through genomic sequencing for oncologists and AI data licensing to AstraZeneca, GSK, and Merck.
Q1 2026, revenue $348 million, up 36%. Non-GAAP EPS negative 13 cents beat the negative 20-cent estimate. Data and applications revenue grew 40%. FY 2026 guidance raised to $1.59 to $1.6 billion.
Welcome to Charged Alpha. I'm Hudson, and tonight we're covering Tempus AI, ticker TEM, Q1 2026 earnings. Tempus has built what might be the most valuable dataset in medicine, and it's just starting to monetize through AI. Lana, Q1 tests whether the pivot from genomics lab to AI data company is working.
And the answer is, it's working. Revenue came in at $348 million, up 36% year over year, beating estimates by 4%. The company raised its full-year guide. But a massive EPS miss is creating noise, and we need to separate the signal from the accounting. Let's get into it.
Let's start with what Tempus actually does, because this is not a typical healthcare company. Tempus was founded in 2015 by Eric Lefkofsky, the serial entrepreneur behind Groupon, after his wife was diagnosed with breast cancer. He was stunned to find that oncology data was scattered across hospitals and labs, never integrated into a system that could learn from it. So he built one.
The business has two interlocking parts. First, diagnostics. Tempus runs genomic sequencing tests on tumor DNA, RNA, and blood for cancer patients. Oncologists order these tests to guide treatment decisions. Insurance covers most of them. In Q1, that segment generated $261 million in revenue, 35% growth year over year. Oncology volume grew 28%, and a newer test category called minimal residual disease, or MRD, which monitors for cancer recurrence in the blood, grew 500% off a small base.
The second business is data and applications. Every test Tempus runs adds to its proprietary dataset, over 500 petabytes of de-identified genomic sequences, pathology images, and clinical outcomes. Pharmaceutical companies pay to access this data to run drug discovery programs, build AI models, and identify biomarkers. That segment generated $87 million in Q1, up 40% year over year, with the Insights subline, data licensing and AI modeling, growing 44%. This is the part that excites investors most.
The two segments reinforce each other. More tests ordered means more data. More data means better AI models. Better AI models attract more pharma partners. More pharma revenue funds, more test capacity. Eric Lefkofsky called it a flywheel, and the Q1 numbers suggest it's spinning faster. Net revenue retention on the data business came in at 126%, meaning existing customers are expanding their spend year over year.
Now for the headline numbers. Total Q1 revenue was $348 million, up 36%, beating the consensus estimate by $14 million. Gross margin came in at 63.8%, with diagnostics at 62% and data and applications at 73%. Gross profit was $222 million. The underlying economics are genuinely attractive.
Here is where it gets complicated. GAAP EPS came in at negative 71 cents versus the estimate of negative 10 cents. That looks like a massive miss. But let's break it down. $56 million of that loss came from stock-based compensation, a non-cash charge. Another $32 million came from unrealized losses on marketable securities, also non-cash. Strip those out, and adjusted EBITDA was just negative $3 million for the quarter. The company expects to generate $65 million in positive adjusted EBITDA for the full year 2026.
Cash position.
The pharma partnership momentum is the most important narrative shift at Tempus right now. Merck was added in Q1 as a major strategic partner, comparable in scale to AstraZeneca, GSK, and Bristol-Myers Squibb. AstraZeneca's deal alone is worth $200 million, building the largest...
What changed here is the nature of the relationship. Tempus used to sell access to data on a project-by-project basis. Now pharma companies are making multi-year platform bets, licensing the entire dataset and co-developing proprietary AI models. That is a fundamentally more durable revenue stream, and it reflects the underlying supply-demand reality. Pharmaceutical companies need clinical data to train next-generation AI drug discovery models, and Tempus has data that cannot be replicated by any competitor in the near term.
Eric Lefkofsky put it directly on the call. He said, quote, "I do not think anyone thought our data business and modeling business would get to this scale, would be growing this quickly at this scale, or would be this durable." That is a CEO who is surprised by the upside. It also helps explain why the stock reaction to the quarter was relatively muted. Despite the EPS headline miss, investors heard the strategic story and stayed.
Let me walk through the bull case. The data moat is the heart of it. Tempus has spent a decade building physician relationships, signing hospital contracts, and processing tens of millions of clinical samples. Every test adds to a dataset that is becoming more valuable over time, not less. Pharma companies are not just buying historical data. They are paying for ongoing, prospectively collected clinical data tied to real treatment outcomes. That is the raw material for the next generation of cancer drugs.
Second, the precision medicine wave is structural. Clinical guidelines are increasingly mandating comprehensive genomic profiling before initiating cancer treatment. The National Comprehensive Cancer Network, Medicare, and major payers are expanding coverage. That creates a durable volume engine for the diagnostics segment that does not depend on Tempus winning new accounts. The market is expanding beneath it, And as sequencing costs fall, more test types become economically viable, expanding the addressable market further.
Third, the path to profitability is more visible now than it was 12 months ago. Adjusted EBITDA was negative $3 million in Q1 and is guided to positive $65 million for the full year. That means roughly $17 million per quarter of EBITDA improvement is expected across Q2 through Q4. If the data segment keeps growing at 40%, its 73% gross margin will increasingly cover the overhead structure of the diagnostics business. The unit economics here actually work. It is just a matter of scale.
Now the bear case. The EPS miss was severe, negative 71 cents versus a negative 10-cent estimate. Even adjusting for non-cash items, the GAAP loss was $126 million on $348 million of revenue. A company with a 36% negative net margin is burning real capital. The $644 million cash balance provides a runway, but if growth decelerates or pharma deal closings slow, that buffer shrinks faster than management projects. Markets are unforgiving with pre-profit growth companies when narratives slip.
Reimbursement risk is the structural bear argument. About 75% of Tempus revenue comes from diagnostics, which means it comes from insurance companies paying for genomic tests. CMS coverage decisions and commercial payer policies can change. Any broad pullback in reimbursement rates for molecular diagnostics, something that has happened before in this industry, would hit Tempus's revenue base faster than any moat argument could offset. That risk is real and not fully reflected in analyst models.
Versus peers, Guardant Health focuses on liquid biopsy and trades at nearly 5 times revenue, a premium to Tempus's 1.2 times. Guardant's Shield colorectal test has FDA approval and is pursuing Medicare coverage. Illumina makes sequencing instruments. Tempus depends on. Revenue is flat, but platform dominance is unquestioned. Recursion Pharmaceuticals trades on the AI and biotech narrative, but has far less clinical data and more binary pipeline risk. Tempus sits in the middle, more proven than Recursion, more diversified than Guardant.
On the options and positioning side, TEM is a high-beta, pre-profit growth stock that attracts speculative flow. The put-to-call ratio heading into earnings was elevated, around 1.15, reflecting investor caution about the EPS number. That caution was justified by the GAAP miss, but the stock only fell 3%, meaning the revenue beat and guidance raise absorbed most of the negative EPS surprise. Post-earnings, call buying has picked up in the $60 to $70 strike range as traders position for a re-rating if the EBITDA inflection materializes in Q2 and Q3.
On insider activity,
For context on IPO timing, Tempus went public in June 2024 at around $40 a share. The stock ran to nearly $80 in the months after IPO on the AI and healthcare narrative, then pulled back to the low 30s before recovering to the current $55 range. For investors who bought in the 30 to 40 range, this is a profitable entry. For those who bought near 80 at IPO euphoria, the stock still needs meaningful progress on EBITDA to justify a return to those levels.
Looking at the valuation landscape, Tempus currently trades at about 1.2 times forward revenue on the 2026 guide of $1.6 billion. That is a significant discount to peers like Guardant at nearly 5 times, which reflects the EPS uncertainty and the fact that Tempus has more near-term profitability pressure. If the company delivers $65 million in adjusted EBITDA as guided and maintains 25% revenue growth through 2027, a re-rating toward 2.5 to 3 times revenue is achievable. That would imply a stock price in the high 70s to mid-80s.
So where does this leave us? Tempus AI is executing at an impressive level on its core strategy. 36% revenue growth, a gross margin approaching 64%, and the world's largest pharma companies making $100 million bets on its dataset.
The risks are real: profitability timing, reimbursement policy, and competitive pressure from Guardant and Foundation Medicine. But with over $600 million in cash, a clear EBITDA inflection story for 2026, and partnerships now representing over $1 billion in remaining contract value, Tempus has more financial runway and strategic validation than it did at IPO. This is a conviction story on the AI meets genomics intersection, not a momentum trade.
That is a wrap on Tempus AI Q1 2026 here on Charged Alpha. If you found this breakdown useful, subscribe wherever you listen to podcasts and leave us a review. It helps more investors find the show. We have more earnings coverage coming all season long. I'm Hudson, she's Lana. Thanks for listening, and we will see you next time. This content is for informational and educational purposes only. It is not financial advice. Consult a licensed financial advisor before making any investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.